Today we're going to be talking all about your debt to income ratio and what the lenders don't tell you. Hello, welcome back to our channel and podcast. My name is Gemma and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Ifti joining us once again. And for those of you who don't know Ifti, Ifti is a trained accountant and mortgage advisor who has been in the industry for over 11 years. He is also one of the founding directors here at WIS. How are you doing, Ifti?
Hi, I'm very well, thank you. How are you, Gemma?
Yes, I'm good, thank you. So today we're talking all about debt to income ratio. So I guess a good place to start is, what is debt to income ratio?
Okay, cool. That's quite simple. If you take all your debt and you divide it by your income, that's actually debt to income, right? So I'll just use an example. If somebody has, say, 50,000 debt, right? And let's say their income is 100,000. So their debt to income ratio is about 50%, right? So that's kind of what it means. So that's your debt to income. So when you say debt, you need to add up all your loans, right? Your credit cards and your commitments that you have financially, which you'd normally find in your credit file, right? So if you add up all that, that becomes your debt. And your income really depends on what type of work you do. Because some people, if they're self-employed, generally the bank looks at your tax returns, or they say 302s. If you're employed, it's your payslip, what you show as numbers in your payslip, right? So that is your income. So depending on what you do, that number will vary as well. Again, if you're not sure, you can ask some advisor. They'll be able to guide you on this one.
Okay, thanks, Ifti. Now, kind of getting to the juicy bit. What is it that lenders don't tell you about your debt to income ratio?
Right. So you got to be very careful with this question, right? Because what happens is most lenders will tell you what it is, right? They'll say, okay, we will accommodate people who have like 50% debt to income ratio, right? Meaning the same example we used before, 50,000 divided by 100,000 income. Now, some lenders will say 25%, each lender has a different appetite when it comes to this subject, right? So it varies. And some lenders very clearly say, if you have people who have debt more than 50%, please don't apply because your application is going to get rejected, right? So some are very clear on that. Now, this is where the complication is. Some lenders are not clear on this, right? Because they say, okay, we look at it as a whole, right? Because they look at the merits and the demerits of the mortgage application, right? Now, that's where it gets complicated, right? Because the answer is there's no defined percentage, right? So we don't know what is the debt to income ratio. There might be clients who might have high debt to income ratio, but they might still get the mortgage because they look at the total merits of the case, right? So that's what it is. Usually experienced brokers will know which kind of lenders might not like these scenarios, right? Even though it's not defined in their lending criteria. That's where you have to be very careful, right? If you have high debt to income, you probably don't want to go to certain lenders because even though it's not clear, they might not accept your application, right? So that kind of comes through experience because a lot of advisors would know which lenders to avoid, right? Because they don't have defined criteria. So that's where you have this problem.
Okay, what about a scenario if you're remortgaging to settle debt? How do they look at that?
Yeah. So again, some lenders look at it favorably. Some lenders worry about it, right? That's where we have a problem, right? Because they look at your past history. So if you look at your credit file for the last 6 years, you sometimes see waves, right? It goes high, it comes down, goes high, comes down. If they do a remortgage, take the money, settle the debt, 2 years down the line, they go and rack up debt again, right? So if you have history like that, lenders are not going to like it, right? So you have to be very careful. Yes, lenders like you to, reduce your debt. And some lenders are very happy to give money towards debt consolidation. But saying that at the same time, some lenders worry looking at your past history as well, right? And they look at your track, right? So if suddenly you have racked up debt over the last 1 year, they really worry, right? What it is. And they might, have a problem with it. Again, some lenders, as standard, they say, okay, you're doing a remortgage, we still use the normal debt to income ratio. And therefore, you have to follow our procedure. And, if you're, say, more than 50% or 25%, you can't apply. So they might give those definitions quite clearly. But the problem is some lenders are not very clear on that, and they look at your past history as well. They analyze your credit file very well. So that's why it's a good idea. If you have high debt, it's probably best to speak to an advisor, because the advisor will know what kind of things the banks are looking for and what kind of banks will be happy with this as well. right? Because you might go to a bank A, B, and C, and all three might say no, right? Whereas you should have actually gone to bank D, because bank D is relaxed with some of these things, right? Because now what it's done is, if you go on to bank A, B, and C, it probably would have affected your credit file because you already run 3 credit searches, right? So that's the bit you have to be a little careful about.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
Would you say there is such a thing as a good debt to income ratio? And if so, what is it?
There isn't a definition as such, but it really depends on the bank, right? Because some banks will define 20%, 25%, some will say 50, some will say not more than 50,000. They will have those numbers. So there isn't a real number as such which you can say it's a good thing, but the lower the number is, the better for you, right? Because the debt income ratio always has to be low. What the banks are worried about is the customer risky? If you have high debt, say 50%, that is a lot of money, right? Because 50% of your income is your debt, right? So banks worry, right? Because they think you might have lost control over your finances, right? So you become a risky customer, right? So that's the one you must try and avoid, right? So I think to a certain controllable level, banks are happy, right? But beyond that, you have to be careful. I mean, where we live, right? Today, a lot of people do have debt, right? Because they have a car loan, right? A lot of people do have car loans or PCP or whatever it is you call it, right? You do have those loans, right? I mean, they're okay, right? Because that they generally expect that, right? But if you get, 3 car loans or whatever it is, now that's something that they worry about, because that might be a lifestyle issue. You like cars and you like to buy cars, right? And they worry about those things. So that's the one you have to try and avoid. So the lower the debt to income is always better. So there's no defined number. It depends on the lender. But let's forget lenders for the moment. From a common sense point of view, it's always best to have low debt to income ratio.
So what are you saying, sort of someone who say is on a salary of 30,000 a year, if they've got debts of more than 15,000, that's where lenders might sort of seem to have a problem?
Yeah, they would. But again, depends on the income as well, right? Now, because a lot of lenders, they only start giving you a mortgage when you earn, say, 25,000, right? So if your salary is 30, you've just crossed that line, right? So that's when lenders are actually starting to think of you. But then if you have debt as well, along with that, because your salary is actually, it's decent, but it's not massive in the grand scheme of things as well, right? So if you have high debt and your salary is not as much, and let's say you're a sole applicant, lenders may have a problem with that, right? So try to keep it manageable, right? Again, somebody earning 30K, I'm sure they'll want to have a nice car and, they will take a car loan, right? So we see that, right? But, that's kind of okay. But apart from that, if they rack up credit card balances of 10K, 15K, or whatever it is, that may not work very well with the lenders, right? But, sometimes a car will cost you 15,000, right? Because most cars do nowadays if you buy a, fairly new car, right? But then, if your monthly payment is something like £300, £400, the lender will accept, right? So it really depends. So if you have anything complicated, it's always best to get some advice on this just before you apply for a mortgage,
Yeah, and I feel like not a lot of people know this, but also some people say like, oh, I don't have any credit cards, like, well, I don't have any with any balances on at the moment. And then, you say, well, how many credit cards have you got? And they say, oh, I've got 4. And then you're like, okay, well, how much limit does each card have? Oh, one's got 10,000, one's got 15,000, one's got 3,000, one's got 4,000. How would you say a lender would look at that scenario and why that might be an issue?
I think that's a very good question. Those credit card balance, it's not a balance, right? It's only a limit, right? That doesn't really add to your debt to income ratio. But the bank knows if you have those cards open, right? Let's say that adds up to 50,000. Overnight, you can rack up 50,000 debt, right?
Yeah.
So that's the ones that banks sometimes worry about. If you have cards with a lot of headroom, right? They like if you have a lot of headroom, but they do also worry about, you quickly going and using that headroom as well, right? Again, those things are not defined, right? Most banks don't define that. That's the one you have to be careful about. Even if you have those things along with debt, it's not a good combination because bank knows, Okay, the guy has 50,000 debt and he has credit line of another 50,000 on the side, right? So because anytime he can become from 50 to 100, overnight he can do that, right? So then your debt to income becomes like 1 or 100%, right? So if it's 100%, it's very dangerous. So yes, that's why I said they will look at the merits of the case. So if you have high debt to income, plus if you have these kind of credit lines open for you, it's not a good combination, right? So I think that's a very, very good question.
So how can we help people that do have a high debt to income ratio? What can they do to help
I think you need to
themselves get a mortgage?
I think you need to get advice for sure, right? If somebody is doing debt consolidation, I mean, we consider them as vulnerable customers and we have interviews with them, right? Because we just want to make sure that they're doing the right thing before we telling them, okay, you can take a mortgage to settle your debt, right? Because we always try to see whether there's other things they can do. Because again, we try to see whether there's anything that we can control as much as possible. Because, the worst thing is for you to settle your debt and go and collect more debt somewhere else later, right? So that's something that you have to be careful about. That's why I'm saying if somebody has debt, it's always best to get some advice. If you're going for a mortgage or a remortgage, it's probably best to settle some of the loans. It's not settling the loan today and saying, okay, let's do the mortgage tomorrow. Because sometimes what they do is clients borrow money from their parents, settle the debt, and then go and borrow and pay the parents back, right? So obviously they wouldn't tell us that, but they do it, right? So banks worry that you do that, right? So be careful when you're trying to do this. That's why I said, if you have debt, I think it's always a good thing for you to speak to an advisor and get some guidance, right? Because debt can be very serious, right? Obviously, the mortgage is also secured. And, if you have high debt, sometimes, it can eat into your mortgage as well, right? So you have to be very careful with this, right? But if you have high debt, it's always best to have conversations because in my view, most of them will fall under the vulnerable customer category, right? So, yeah.
I'd also like to say that I feel like sometimes there's this idea that maybe if they just didn't say anything, or they forget to mention one, loan or something that perhaps people might not notice. But I definitely would like to say that there isn't really any way to hide that from a lender.
Yeah.
They will be able to see your debts. And, if you didn't tell the advisor that you had that debt, then, that's just not a great route to go down, is it? Because they will find out in the end.
Yeah, I mean, today banks run a credit search, right? So it is in your credit file. If there's a debt and it's in your credit file, they see it, right? So you can't hide stuff, especially when it comes to financial commitments, right? They will see it, right? Banks are clever, so they will pick this up anyway, right? So it's always best, to be very transparent with whoever is giving you advice, because if you're not being transparent, unfortunately, the advice they give might be wrong because they don't have all the information, right? So it's always good to download a credit file before you meet an advisor and go through your credit file with them, right? Because that will give them a very good picture of you, right? So if they can build that picture, it's always easy to advise. I mean, it doesn't take advisors long to go through credit files, especially if you're experienced, because they know what to look at, right? So yeah, credit files are very helpful. If you can download that and speak to an advisor, that's always a good thing.
And it's not all doom and gloom, is it? Because even, people that are in debts, there are specialist lenders who will look at your mortgage case.
Yeah.
You might end up having to pay, a higher rate or a product fee, but, there are still ways that you can get a mortgage.
Yeah, definitely. I mean, sometimes it's a good idea to do this because what happens is your debt might be expensive, right? I've seen people paying 15% interest on credit cards, right? So for them, if there's no other option, this may be a better option because otherwise it's going to cost you, right? But again, this is not advice to everybody. This advice has to be very specific to people. If you do have debt and you want to consolidate and settle that, always get advice, right? That's always the best thing to do. Don't just blindly do it. Yeah.
Yeah. All right. Thanks, Ifti. Is there anything else you wanted to add today?
Yeah. I mean, obviously debt is a bad thing sometimes, right? So, just be careful because it's easy, right? Because banks sometimes give you credit cards with big limits, right? It's easy for you to rack up your credit card balances. It can affect your mortgages. Just because sometimes your friend managed to get through with a mortgage doesn't necessarily mean that you're going to get through, right? Because they look at the case as a whole, right? So you have to be very careful. Try not to take unnecessary debt as much as possible. Sometimes, like I said, it's unavoidable. You want a car and, the only way you can get it is sometimes a car loan, right? So you have no choice. But there are certain instances which you can avoid. Don't rack up your balances while going on holiday and doing stuff like that because, if you don't have a proper plan, you sometimes can't settle those balances. But that can affect your mortgages, right? Or it can affect the amount you can borrow. Or in some instances, you might not get a mortgage at all, right? Or you might get a mortgage which is expensive, right? So those are not the scenarios that most people want to be in. So as much as possible, if you can avoid it, avoid taking unnecessary debt, right?
Yeah, it's interesting because on the other hand, a lot of lenders almost need you to have that one credit card to show that you repay it on time. And so, but just I guess remember that in proving that you can pay back debt, make sure you do it with a small balance. We always say something like, don't spend more than £50 on your credit card a month and pay it back straight away. That can build good credit.
Yeah,
that could be good for your mortgage case to make sure, so that lenders can see that you can repay debt in a timely manner. So it's not all bad, but just I guess if it goes out of control, that's when lenders start to worry.
Yeah.
All right. Thanks, Ifti. Thanks, everybody, for joining us again this week. I just wanted to give you our usual reminders that a mortgage is secured against your home or property, so it may be repossessed if you do not keep up with the mortgage repayments. And also, if you don't have an advisor, I will leave our WIS contact details below, as we're always more than happy to help. Thank you for joining us again today. Have a great week. Stay safe. We'll see you again soon.